Imagine walking through the gleaming towers of downtown Toronto, those beautiful glass condos stretching into the sky, symbols of prosperity, symbols of growth, symbols of the Canadian dream. Now imagine that behind those shimmering windows, unit after unit after unit sits completely empty. No furniture, no people, no life. Just darkness and silence in what should be one of North America's most vibrant cities. Right now, as you're watching this video, over 60,000 condos in the Greater Toronto Area are sitting vacant, and the mayor is scrambling to figure out what to do before the entire market comes crashing down. This is not speculation. This is not fear-mongering. This is the reality unfolding in Canada's largest city, and the implications are going to send shockwaves through the entire economy. If you want to stay ahead of what's happening in real estate and economics, make sure you hit that subscribe button right now and turn on notifications, because stories like this are exactly why you need to be paying attention. Let's rewind for a moment and understand how we got here, because this crisis didn't happen overnight. Toronto has been one of the hottest real estate markets in the world for the past 2 decades. People from all over the globe looked at this city and saw opportunity. They saw stability. They saw a safe place to park their money. And for years, that bet paid off spectacularly. Property values doubled, then doubled again. A condo that sold for $300,000 in 2010 was suddenly worth over $700,000 by 2022. Everyone wanted in. Developers couldn't build fast enough. Cranes dominated the skyline, and Toronto earned the nickname the crane capital of North America, because at one point, more construction cranes were operating here than in any other city on the continent. But here's the thing about markets. They don't go up forever. And when you build an entire economic ecosystem around the assumption that prices will always rise, you're setting yourself up for catastrophic failure when the music finally stops. The music has stopped. Let's talk about those 60,000 empty condos. This number comes from a combination of sources, including real estate analytics firms, city data, and investor surveys. These aren't units under renovation. These aren't units between tenants. These are condos that were purchased, in many cases years ago, and have never been occupied. They were bought as investments, pure and simple, by people who had no intention of ever living in them or renting them out. The strategy was straightforward. Buy a pre-construction condo, wait for it to be built, close on it, maybe hold it for a year or two, and then flip it for a massive profit. This worked beautifully when prices were climbing 15, 20, sometimes even 30% per year. You didn't need rental income. You didn't need to deal with tenants. You just needed to wait. But then, interest rates started climbing. The Bank of Canada, facing the worst inflation in 40 years, had no choice but to raise rates aggressively. Suddenly, that investment condo that made sense when your mortgage was 2.5% became a massive liability at 6%. The carrying costs exploded. Investors who were barely breaking even before were now bleeding thousands of dollars every single month. And the exit strategy, selling for a profit, evaporated as buyers disappeared from the market. Mayor Olivia Chow has been watching this disaster unfold from City Hall, and the panic is becoming increasingly evident. In public statements and council meetings, there's been a noticeable shift in tone. The confidence that characterized Toronto's leadership during the boom years has been replaced by urgent discussions about intervention, vacancy taxes, and emergency measures. The city implemented a vacancy tax in 2022, charging owners of empty homes 1% of the property's assessed value annually. Sounds significant, right? 1% of $1 million condo is $10,000 a year. But here's the problem. 1% is nothing compared to the losses investors are already absorbing. When you're losing $3,000 a month on carrying costs and watching your property's value decline by hundreds of thousands of dollars, a $10,000 annual tax is barely a rounding error. It's not changing behavior. The condos remain empty. There's now serious discussion about increasing that vacancy tax to 3%, possibly even 5%. City councilors are floating ideas about converting empty units into social housing. There are proposals to force developers to include more affordable units in future projects. But all of these solutions face a fundamental problem. They're treating symptoms while the disease continues to spread. Let me give you some context on just how bad the situation has become. In the pre-construction condo market, which is where developers sell units before they're even built, sales have collapsed by over 70% compared to the peak. 70%. Developers who launched projects expecting to sell out in weeks are now sitting on inventory for months, sometimes years, with no buyers in sight. And these aren't small developers. Major players with decades of experience and billions of dollars in assets are pausing projects, canceling launches, and in some cases, walking away from sites entirely. The ripple effects are enormous. Construction workers are being laid off. Architects and engineers are seeing their project pipelines dry up. Real estate agents who specialized in pre-construction sales are leaving the industry entirely. Mortgage brokers are struggling to find qualified buyers. The entire ecosystem that grew up around Toronto's condo boom is now contracting rapidly. But wait, you might be thinking, if there are so many empty condos, why don't the owners just rent them out? Wouldn't that solve the problem? Great question, and the answer reveals just how dysfunctional this market has become. Many of these investor-owned condos were purchased with the explicit assumption that they would never need to be rented. The investors, many of whom are located overseas or in other provinces, have no interest in becoming landlords. They don't want to deal with tenant issues, maintenance problems, or the regulations that come with being a rental property owner. They bought these units as financial instruments, not as places for people to live. Converting them into rentals would require effort, time, and ongoing involvement that simply doesn't fit their investment thesis. Additionally, many of these units were purchased with minimal down payments through assignment sales and creative financing arrangements. The investors are so deeply underwater that even collecting rent wouldn't cover their costs. They're essentially trapped, unable to sell because they'd crystallize massive losses, unable to rent because the math doesn't work, and unable to just walk away because of personal guarantees and legal obligations. Now let's zoom out and look at what this means for the broader Toronto housing market, because this isn't just an investor problem. This affects everyone. Toronto has been dealing with a housing affordability crisis for years. Young families can't afford to buy homes. Renters are paying astronomical amounts just to put a roof over their heads. There's been an endless debate about supply versus demand, about immigration levels, about zoning laws and development charges, and hovering over all of it has been this massive shadow inventory of empty condos that could, in theory, help address the housing shortage. But here's the cruel irony. Those 60,000 empty units aren't actually available to the people who need them. They're locked up in investor portfolios, sitting vacant while people sleep in shelters and on the streets. The market has failed to allocate housing to those who actually need it. Instead, it's allocated housing to those who can afford to let it sit empty. That's not a functioning market. That's a market that is completely broken down. The mayor understands this, which is why the panic is setting in. When you have a housing crisis and simultaneously have tens of thousands of empty homes, you have a political problem that's impossible to explain to voters. How do you tell a young couple that they can't afford to start a family in the city they grew up in when there are entire floors of condo towers with no one living in them? How do you tell a senior citizen facing rent eviction that the market is working as intended? You can't. The optics are devastating, and politicians know it. There's another dimension to this crisis that doesn't get enough attention, and that's the role of international money. For years, foreign investors viewed Canadian real estate, particularly in Toronto and Vancouver, as a safe haven for capital. The reasons were understandable. Canada has stable political institutions, strong property rights, a reliable legal system, and a welcoming attitude toward international investment. If you were a wealthy individual in a country with less stability, parking your money in a Toronto condo made a lot of sense. But this capital inflow had consequences. It drove up prices, which benefited existing homeowners, but made housing increasingly unaffordable for everyone else. It also created a dynamic where housing was treated primarily as a financial asset rather than as shelter. The foreign buyer taxes implemented in recent years were supposed to address this, but they came too late and were too easily circumvented through corporate structures and domestic proxies. Now, with the market turning, many of these international investors are facing a difficult decision. Do they sell at a loss and move their capital elsewhere? Do they hold on and hope for a recovery that may not come for years? Or do they simply stop paying their mortgages and let the banks foreclose? Each of these scenarios has different implications, but none of them are good for market stability. Let's talk about what happens next, because this story is far from over. The most optimistic scenario is a gradual adjustment. Investors slowly sell off their holdings, prices decline modestly over several years, and the market eventually finds a new equilibrium at more sustainable levels. New buyers enter the market, rents stabilize, and life goes on. This is what the real estate industry desperately wants you to believe will happen. But there are reasons to be skeptical of this rosy outlook. For one, the math simply doesn't work for many of these investors. They can't afford to hold indefinitely, and they can't afford to sell without realizing catastrophic losses. At some point, something has to give. Either they default on their mortgages, or they engage in distressed sales that further push down prices. Neither option supports the gradual adjustment narrative. There's also the question of developer solvency. Many developers took on enormous debt to finance their projects, expecting to sell units at prices that no longer exist in the market. If they can't sell enough units to cover their costs, they're going to face serious financial difficulties. Some will go bankrupt. Others will be acquired by larger players at pennies on the dollar. The consolidation that follows will reshape the industry for years to come. And then there's the banking sector. Canadian banks have significant exposure to real estate, both through residential mortgages and through construction loans. If defaults start rising substantially, the banks are going to feel the pain. They'll tighten lending standards, which will further constrain demand, which will push prices down further. It's a negative feedback loop that can accelerate quickly once it gets started. The federal government is watching all of this nervously. Housing has become one of the most politically charged issues in Canada, and there's no easy solution. Lower interest rates might help in the short term, but the Bank of Canada has to balance housing concerns against its inflation mandate. Immigration policy is another lever, but reducing population growth would slow economic activity at exactly the wrong time. There are no good options, only trade-offs. What should you be paying attention to as this situation develops? First, watch the pre-construction market. This is where the stress is most visible. If new project launches continue to fail, and if more projects are canceled or delayed, that's a sign that the industry expects things to get worse before they get better. Second, watch rental prices. If owners start converting their empty condos into rentals in significant numbers, you'll see it in the data. Rental listings will increase, vacancy rates will rise, and rents will start to decline. This would actually be good for affordability, but it would also signal capitulation by investors who have given up on the appreciation strategy. Third, watch for developer bankruptcies or restructurings. These won't happen quietly. When a major developer runs into trouble, it makes headlines. The projects get delayed. Purchasers who put down deposits start to worry about getting their money back. The confidence that's essential for real estate transactions starts to erode. Fourth, watch what the city does. If Mayor Chow and the council start implementing aggressive interventions, like dramatically higher vacancy taxes or compulsory purchase programs, that's a sign that they believe voluntary market adjustments aren't happening fast enough. Political desperation often leads to policy mistakes, but it can also lead to creative solutions that wouldn't emerge under normal circumstances. Now, I want to be clear about something. I'm not hoping for a market collapse. A crash in Toronto's housing market would cause real pain for real people. It would wipe out the savings of families who bought at the peak. It would put construction workers out of jobs. It would ripple through the entire Canadian economy in ways that are hard to predict. Nobody should be cheering for that outcome. But at the same time, we have to be honest about what's happening. The market got distorted by years of cheap money, speculative excess, and policies that prioritized asset price appreciation over housing affordability. The correction that's now underway is painful, but it's also necessary. A market where 60,000 condos sit empty while people can't afford housing is a market that needs to change. The question is whether that change happens gradually and manageably, or whether it happens suddenly and catastrophically. Right now, the signs are pointing toward the latter. The numbers are too stark, the imbalances are too severe, and the policy responses have been too weak. Something is going to break. And when it does, the consequences are going to be felt far beyond Toronto's city limits. For those of you watching who own property in Toronto, now is the time to be realistic about your situation. If you're an investor holding an empty condo, you need to seriously consider your options. Holding indefinitely in the hope of a recovery might work, but it might also mean years of carrying costs and mounting losses. If you're a homeowner who isn't planning to sell anytime soon, short-term price fluctuations matter less, but you should still be aware of the broader dynamics affecting your market. For those of you looking to buy, patience might be rewarded. Prices in the condo market have already declined significantly from the peak, and further declines are possible, perhaps even likely. That said, trying to time the bottom of any market is a fool's errand. If you find a home you love at a price you can afford, and you're planning to live there for many years, the exact timing matters less than you might think. For those of you watching from outside Toronto, don't assume this is just a local story. Real estate markets across Canada are interconnected. A major correction in Toronto would affect confidence nationwide. It would affect banking and lending. It would affect construction and employment. And it would inform policy decisions at every level of government. What happens in Toronto doesn't stay in Toronto. The next 12 to 24 months are going to be fascinating and terrifying in equal measure. We're going to see how resilient Canada's housing market really is. We're going to see whether the interventions that have been proposed can make a difference. We're going to see how investors respond to continued losses and how banks respond to rising defaults. And we're going to see whether Mayor Chow and her counterparts at the provincial and federal levels can navigate this crisis without making it worse. I'll be covering this story closely in the months ahead, bringing you the data, the analysis, and the insights you need to understand what's happening. If you found this video valuable, please take a moment to hit that like button. It really helps the algorithm share this content with others who need to see it. Leave a comment below with your thoughts. Are you in Toronto? Are you an investor dealing with this situation? Are you a renter hoping prices will finally become affordable? I want to hear from you. And if you haven't already, subscribe to this channel and hit the notification bell so you don't miss future updates. This story is just beginning, and you're going to want to stay informed as it unfolds. Thanks for watching, and I'll see you in the next one.